If you've ever wondered how commercial real estate investors or investment firms buy buildings that are worth 10, 50, $100 million or more, the secret to this is that these investors almost never buy these properties completely by themselves. The commercial real estate industry is powered in large part by equity partnerships that essentially bring investor capital together to buy individual deals or portfolios of properties that might come in at that 8 or 9 figure price point. But exactly how these partnerships tend to work can get pretty complex. So in this video, I want to walk through the mechanics of a real estate equity partnership structure, how these tend to function in practice, and the different aspects of these agreements that have the biggest impacts on a real estate deal. So the first thing to note about real estate equity partnerships is that these generally have two main components: a general partner or GP on the deal and a limited partner or LP on the deal. Now, there can be multiple GPs or LPs within a partnership, but regardless of how many parties are on each side, the GP and the LP are each going to be responsible for very different things related to a deal. On the LP side, a limited partner essentially acts as a silent money partner on a deal that brings the majority of the equity required to close, and usually the LP on a transaction will not be an experienced real estate investor or won't have the time or resources to manage deals on their own. So in exchange for bringing that capital to the table, the LP is usually looking for a very hands-off investment opportunity. This is why LPs are generally considered passive investors, since they are not going to be the ones responsible for acquiring, managing, or selling a deal, and in the vast majority of cases, they also won't have a say in how these things are done. In a real estate deal, there are often multiple limited partners on a transaction, especially on deals that are priced in the $2 to about $15 million range, with the most common investors in these types of deals being high income earners, either inside or outside of the real estate industry, or high net worth individuals that want exposure to real estate but don't want to buy and manage properties themselves. And sometimes there will only be one limited partner on a deal, and in these cases, this is usually a major private equity firm, a pension fund, a family office, or even a single wealthy individual that's looking to deploy a lot of capital all at one time and usually wants to have more of a say over the terms of the agreement. Now, if the limited partner or limited partners are not responsible for acquiring or managing a deal, this means that another party needs to step up and control this process, and this is where the general partner comes into play. You might hear the GP being referred to as the sponsor on a deal, but either of these terms just refer to the individual, or in most cases, the real estate investment firm that's going to be the one coordinating all aspects of a transaction, including finding a property to buy, raising both debt and equity capital, managing due diligence and closing, managing property operations once the acquisition is complete, and ultimately selling the property on behalf of the partnership, ideally for a profit. And in exchange for all the work this requires, the GP will usually charge fees associated with these things, usually in the form of acquisition fees as a percentage of the purchase price, asset management fees as a percentage of operating revenue, construction management fees as a percentage of construction costs, and sometimes disposition fees as a percentage of sale proceeds. This is why you'll often see investors and investment firms looking to buy the biggest deals they can as quickly as possible, since these fee percentages become much bigger whole dollar amounts as the size of a deal increases, which makes the companies that are able to raise the most capital and control the highest value real estate usually the ones that can generate the highest amount of revenue. Now, if you're watching this and you've ever either owned real estate directly or worked in the commercial real estate industry, you know how much effort and cost goes into identifying a new acquisition, managing portfolio performance, managing construction teams, and managing the sale process overall. So this is by no means an easy process for the GP, but especially as deal size increases, fee generation can start to be substantial for a real estate investment firm. But aside from just fee income, some of the biggest cash inflows to a sponsor come from what's referred to as promoted interest on a deal, which essentially allows the GP to earn outsized returns on a transaction based directly on the performance of each investment they manage. Promoted interest is generally determined by what's referred to as an equity waterfall structure, and this determines the performance metrics that the GP needs to hit before that promoted interest starts to come into play. Now, there are other videos on this channel that go into the mechanics of real estate equity waterfall structures in detail, and I'll link those in the description below. But just to give you a high-level overview of what this looks like, this essentially involves the general partner receiving a percentage of the cash flows that is greater than the percentage of the equity that they contributed upfront, only if they exceed certain performance targets. These performance targets are called preferred returns or hurdle rates and are often based on metrics like the IRR, the equity multiple, or the cash on cash return, and these will directly govern how cash flows are split within a real estate partnership. For example, if we had a partnership structure where the GP invested 5% of the equity required to close, the LP invested the remaining 95%, the preferred return on the deal was an 8% IRR, and the promoted interest was 20%, this means that up to the point when that 8% IRR is hit, cash flows will be split 5% to the GP and 95% to the LP, but on all dollars above that 8% IRR, the GP would now receive an additional 20% of the cash flows over this amount in addition to their original equity interest. In this scenario, this results in the GP taking home 20% of the cash flows above that 8% IRR, plus their original 5% of the remaining 80% of the cash flows that aren't subject to promoted interest, bringing the total GP cash flow percentage over the preferred return to 24% in this case. Or for an even simpler calculation, we could also multiply the LP's 95% interest in the deal by that 20% promoted interest amount, and then add back the GP's initial 5% interest in the deal to also arrive at the same result. And this type of structure is often used within real estate partnerships to align incentives between the GP and the LP on a deal, since promoted interest is based on the returns to that LP directly and is only going to be earned when those returns are hit. This is also another reason why GPs will often try to go bigger faster, because again, these percentage values become much bigger whole dollar amounts when property values also increase, and promoted interest on a $5 million deal is going to be substantially different than promoted interest on a $50 million deal, all else being equal. Now, every real estate equity partnership structure is going to be a little bit different, and how each partnership will operate is going to come down to the exact legal language within a JV operating agreement, including the rights and responsibilities of each partner, the fees that are going to be generated by the GP, and the waterfall structure that's going to impact each partner's cash flows. But in my experience, this is the general framework of how these partnerships come together and what this might look like if you're putting a deal together yourself or passively investing alongside a GP. And if you want to learn more about real estate equity partnerships and how to build models to calculate these cash flow splits between the LP and the GP on a deal automatically in a variety of different waterfall structures, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on partnership structures and equity waterfalls, make sure to hit the like button and let me know in the comments the most common types of waterfall structures you've seen out in the field as an investor or as an industry professional. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.